Imagine Ron Weasley walking into a wand maker's shop, dragging a heavy cast iron cauldron behind him. He needs a new wand and offers the cauldron in exchange. The wand maker looks at it and shakes his head. He already has a cauldron. He wants dragon scales. The trade fails. Hermione would be quick to point out the economic problem here. It's called the double coincidence of wants. In a barter system, a transaction only works if both people happen to want exactly what the other person is offering at that exact moment. If they don't, the entire economy grinds to a halt. Long before coins were minted, societies recognized this inefficiency and started using early forms of commodity money, like these cowrie shells pictured here. Because everyone agreed they had value, you didn't have to find a wand maker who specifically wanted a cauldron. You just needed someone to accept shells. To trade efficiently and actually build a complex society, citizens required a universal tool. They needed an intermediate step to bridge those mismatched desires. The invention of money was an inevitable solution to a basic human problem. This brings us to physical currency, like gold galleons. Money performs 4 distinct functions, shown in this 4-part matrix. First, it acts as a medium of exchange to buy goods. Second, it serves as a unit of account, measuring how much a broomstick is worth compared to a textbook. Third, it provides a store of value, allowing you to save wealth for the future. And fourth, it acts as a standard of deferred payment, so you can borrow today and repay next year. Now for an essential exam tip. Do not confuse what money does, its functions, with the physical traits it must have to do those jobs, its characteristics. To work effectively, physical currency must possess specific physical traits. It needs to be generally acceptable, durable enough to survive many transactions, portable enough to carry around, divisible so you can make change, homogeneous, meaning every coin looks identical, and easily recognizable. Look at this pile of identical, recognizable gold coins. They hold purchasing power for one primary reason: limited supply. If wizards could easily duplicate their gold galleons with a simple magic spell, the market would flood with infinite coins. The currency would lose its value immediately, because scarcity is what gives money its worth. Once a society develops a standardized tool that perfectly aligns these physical characteristics with practical economic functions, individuals can accumulate wealth, and complex trade can finally begin. With a functioning currency in place, the scale of trade grows. Harry suddenly finds himself needing a secure place to store a massive inheritance. At the same time, Ron wants to buy a Nimbus 2000, but he doesn't have the cash on hand. He needs a loan. This is where the retail or high street commercial bank steps in. This image of a Barclays branch represents exactly that kind of consumer-facing institution, operating much like Gringotts in the wizarding world. They provide everyday financial services directly to households and firms. Here is a flowchart showing exactly how they operate. The bank accepts deposits from savers like Harry, paying them a low rate of interest for the privilege. It then turns around and lends that exact money to borrowers like Ron, charging him a significantly higher interest rate. The difference is kept as profit. Commercial banks are private sector businesses. They aren't public charities operating out of goodwill. They keep the economy moving, and they do it because they are driven by the profit motive. Over time, these institutions have expanded their services far beyond basic lending. Today, commercial banks act as agents for payments, processing everyday transactions through credit and debit cards, through online banking and direct debits. They also provide foreign currency exchange for travelers needing different money abroad. Beyond digital transfers, they still provide physical security. Take a look at this vault room lined with silver safety deposit boxes. Customers use these heavily fortified spaces to leave important legal documents, property deeds, and small valuables under lock and key. By moving funds between individuals with excess cash and those running a deficit, commercial banks act as the circulatory system of the modern economy. If commercial banks are just private businesses, it raises a crucial question. Who actually prints the money they lend out? And what happens to everyone's savings if one of these private businesses makes a bad bet and runs out of cash? The answer lies inside institutions like this. This imposing stone building is the Bank of England. It is a central bank, the overarching government-owned regulator of the entire national financial system. You cannot walk into a central bank and open a checking account. Central banks do not deal directly with the public. Instead, they act as the banker for the government itself, holding tax revenues, and as the banker for the commercial banks, holding their reserve accounts. The central bank also holds a strict monopoly on the money supply. As seen in this high-speed printing press turning out banknotes, the central bank authorizes the printing of all paper notes and the minting of all coins, deciding exactly how much physical currency enters circulation. Perhaps most importantly, the central bank operates as the lender of last resort. If a commercial bank faces a panic and runs temporarily short of cash, the central bank steps in with emergency loans to keep the doors open. Without a central bank providing this systemic oversight and acting as a financial backstop, public trust in commercial banks and the currency itself would evaporate at the first sign of stress. The central bank's most powerful responsibility is executing monetary policy. This is the process of controlling the wider economy to achieve one primary macroeconomic goal: keeping the national rate of inflation low and steady. By raising or lowering its base rate, the interest rate it charges commercial banks for loans, the central bank creates a ripple effect through the entire economy. If the central bank raises its rate, commercial banks pass those higher costs on to consumers, making borrowing more expensive, slowing down spending, and pushing inflation down. This summary box details the key takeaways for your exam. Notice the definitive separation of roles. Commercial banks are private, profit-seeking firms dealing with the public. Central banks are government-owned entities dealing only with commercial banks and state finances to maintain stability. A modern economy relies on a delicate three-tiered structure. It requires a universally standardized tool of exchange. It runs on the daily lending and profit-seeking of commercial banks, and it is firmly anchored by the ultimate oversight of a central bank.